No longer is the fear of death the greatest fear retirees have. Recent surveys say that the greatest fear that people have is what? What do you think that is? Well, whether you're listening in by radio or you're watching the podcast, do you know what that is? I would imagine most of you are saying it's the fear of running out of money. It absolutely is the response we get most of the time. I'll just say 9 times out of 10. And I find that no matter at what level somebody is in terms of their total liquid, total investable assets for retirement, that whether it's at $250,000 or $500,000 or $1 million or $2 million or $4 million as an example, even higher, I hear from people when I ask the question in my seminars and my workshops, and when I ask it on the radio or I ask people in person, they say it is the fear of running out of money. It's the concern that you won't have enough money later in life. And why is that? Why would that be? Easy, it's the insidious inflation factor, because over time, and if you know the rule of 72, and I don't mean to be too complicated with math, but at 3.6% as an example in inflation on average, and we know in the last number of years here during this Biden administration, it has been very high. But the way you do it is 3.6 into 72 is 20. That means in 20 years, because that's about the rule of doubling your money. But basically, another way of looking at it is you're going to need, in 20 years, you're going to have monies that are half the value, or you're going to need your monies to grow within 20 years at a 3.6% inflation factor. They're going to need to double. So some of you that are not good at math, you may not have followed all that. But the bottom line is we all understand that inflation impacts our purchasing power. And it's a real thing. Just think about what's going on today in today's world, in today's life, of what it costs. The average American is struggling. Now, many of you as retirees, you may be okay because you saved enough. And maybe it's just a matter of you don't like you're dipping more into your retirement nest egg. You don't want to do that. And that's a key thing of understanding. You want to you want to take from income from your investments, meaning the yields, the dividends and interest, not the principal. That's a key thing. The other big factor with the fear of running out of money is the fact that most people, and the studies say that 70% of people are going to need some long-term care. And the cost of long-term care is huge. And the inflation factor on long-term care over the last 20 years easily has been much greater than the average cost of inflation. And the cost of long-term care is significant. It's significant enough that it can cause a huge problem for people in latter years where they can possibly run out of money. And there's a lot of factors and a lot of things, and I'll talk over time here in the next couple of weeks and next couple of months about having your total planning house in order. I do estate planning workshops, and I talk about the importance of getting your investment house in order and your estate planning house in order and having them integrated so that you have enough money and so you have a smooth transition when you may have some incapacity, et cetera. Well, all that said, that's a pretty long opening all about the fear of running out of money. You are listening to the Retirement Income Source. I'm your host, Drew Pelton. And yes, this is airing on WJBO, iHeartRadio, as it does every Sunday from 11 a.m. until noon Central Standard Time. But do you know what this is? For those of you watching, And those of you listening in, yes, there's some people watching. You know how they're watching? They're watching the podcast that's available on YouTube. This actually is the first podcast session. So we are integrating our radio show right here on the podcast or with the podcast. You're going to be able to listen and see this show anytime you want. Now, this is an hour show, but I will tell you, we will be having shorter clips. I know Karen, my wife, she always says she likes to watch these 7 to 15 minute clips. And maybe today in our world, the attention span is a lot less. You know, it's not just millennials anymore. It's like everybody seems to be in this situation where they don't have an hour's worth of patience, if I may say. But in any case, what is the bottom line? We are launching today and announcing today, and you are watching, if you're watching or you're listening. So those of you listening in by radio, you know that this is also a podcast that now, maybe for many of you, you didn't realize you can listen and watch outside of this radio show. Now, let me say this. The radio show is always available a couple of days after the Sunday show, that you can go back to our website and or go on our website and you can watch. Well, I should say can listen to the radio show, but now you'll be able to go on YouTube and listen and see the show. So again, you're listening to this on WJBO or you're watching on YouTube. This is the Retirement Income Source. I'm your host, Drew Pelton. We're located right here in Baton Rouge, Louisiana. I want to thank the support staff here in my office, as well as those that came from Fort Lauderdale, where our support office is, our national office that supports our 100 offices around the country. I want to thank particularly Rich and Armando for coming in and setting everything up. We got the best of the best equipment here to make it easy to record. So thank you to them, and thank you to all those that produce the radio show after we do our shows and the podcast. So I'll say thank you to Brad Sperling, who's does this for many years for me. So, and that's it. So, and thank you to the staff that supports us on every level, administratively, operationally, certainly the investment house, which is Sound Income Strategies. We're a fiduciary firm, and we proactively, actively manage monies utilizing individual securities with an investment approach that's all about investing for income. Because what do you need when you are retired? You need income. And if you don't need income because you have enough in Social Security or pensions, then why do you invest in income if you don't need income? Because income is what is called yields. Yields are dividends and interest. When you have high income, high dividends, high yields, and you don't need to take it, then what do? You reinvest it and you get capital appreciation from there. You get growth out of the income. It has been shown by studies that investors get greater returns when they invest more for high dividends. It's not as simple as saying that and therefore you can do it, but you want to understand the power of investing for income. This is part of why we named the show the Retirement Income Source. So thank you for being with me this morning. This is the first segment. I am going to be talking today about effective investment approaches. But as I go through a number of different scenarios that I will discuss, I want to bring out first the problems that I see, that then you'll better, I think, appreciate what are the effective ways to do things. Two of the big focuses I'm going to have this morning are, number one, those that buy product when they should be doing planning. When investors are buying product over doing planning that leads them to the best investments, well, that's normally a problem. And that's really the key thing. The problem is buying a product, and the solution is doing planning. And you want to do planning first and invest second. Buying something is not a way to go for maximum effectiveness when you are investing in retirement. So that's a big number one. Number two that I want to talk about today is I want to talk about those that are smart, that are educated, they're either educated academically or they've educated themselves in terms of investing, and they think that the do-it-yourself approach is the only way to go and is the best way to go. Let me first acknowledge this. I know what's out there in the marketplace from other advisors, because many people, thousands, literally thousands of people, have come into my office over the years, and I've seen statements. I see what people do. I see the product buying. I see the poor investment approaches. I see the cookie cutter mutual funds. And these are not the best ways to go. And many do-it-yourselfers have figured out some version of investing for income, and many have done well. I have to tell you, I've never seen a do-it-yourselfer beat what we do, because I don't know how you could. We have an entire team of researchers, analysts, traders, executive team. There's a lot that goes into true professional money management, focused and dedicated to investing for income. It's all about income. So the problem I see for do-it-yourselfers is they believe, probably because they interviewed a number of advisors along the way, and they pretty much determined they could do better. But what you want to know is there is an approach, probably like many of you do-it-yourselfers are doing. It's just that you can do it with help. One of the biggest things I find with do-it-yourselfers is that really what plagues them the most, particularly when one is older, is thinking about their spouse. I find many families may have, and a lot of times it's the man, and it could be the female in the relationship, but the man of the household may be doing the investing, and the spouse, the wife, may not have much interest. And the problem is what's going to happen if and when the spouse passes away, and if they predecease the wife. Well, it could be that the do-it-yourselfer said, well, call such and such, and maybe that's okay. I believe a better way is you want to have lined up a firm that has at least done some investing for you, the do-it-yourselfer, where there's at least a carved out relationship. The wife, as an example, and my example here, is aware of who the firm is, what's being done, even if there's very little interest or even if there is very little knowledge. You want to have that introduction and that connection more formally, as opposed to, well, I have a business card, just as an example. Well, call Drew if something happens to me. Well, okay, but I would say better is at least create the link with some formality. If you have X that you're investing as a do-it-yourselfer, maybe you give a certain percentage that you feel comfortable allowing the fiduciary professional money management firm to invest some of the monies so you more formally bridge the gap. That's the solution for the do-it-yourselfer that may often not be doing as well as they think. So 2 things I'm talking about this morning right now in this first segment. One is don't be a product buyer, and be careful, you product buyers, that either because you did it or because you're considering it, be careful of buying a product from a product salesman. You have a life to live in retirement, and you need to do planning. And planning comes out of a process that has a unfolding plan that ultimately creates a strategy, and that strategy has to be tweaked. Today, I'm giving away the book, Common Sense Income Strategies by Michael Eastham. It's a book I give away quite a lot. I like the book. It's a great book to help you understand the power of investing for income. You first want to understand the power of investing for income. You want to understand what it means, what it's about. And it's not just about buying a product. And it's not just about you can get 2 or 3 or 4% in yields and you did it yourself. You want to have professional money management that is going on and has been developed that came out of, again, a process where there's planning and a plan created with a strategy that gets looked at and tweaked on an ongoing basis. So if you'd like to get a copy of the book, Common Sense Income Strategies by Michael Eastham. He's a CPA, a financial advisor in the Orlando area. He's a friend. He's one of our shareholders. I'm one of the shareholders of our 100 offices. We have about 18 of us that are shareholders. And if you like to get a copy of this book, I highly recommend you getting a copy, sinking your teeth into it, and it'll help you understand the kind of things I'm talking about here on this radio show and on this podcast. All right, I'm going to take a quick break. Thanks for being with me this morning. This is the Retirement Income Source radio show and podcast. And I'm your host, Drew Pelton. And this is our first podcast. And I am excited about looking in the camera. And I'm excited about you being able to have the opportunity to watch the podcast at your leisure. All right, stay tuned. You don't want to miss it because I'm going to talk more about the problems with product buying only, the problems with being a do-it-yourselfer, and the problems overall of not doing good strategic planning that involves a process and a good approach. All right? So that's it. Stay tuned. Don't miss a minute. Welcome back to segment 2 of the iHeart WJBO radio show and our first podcast. Now, if you're watching the whole thing, because I had a little break in the action from segment 1 to segment 2, candidly, I forgot if I had my glasses on or not, and I forgot if I had my jacket on. Just to tell it like it is, I actually had to meet with a client. So when you're doing radio only, well, I have a lot more flexibility. But now that we are on camera, well, it's all good. So those of you that are listening in by radio, it doesn't matter anyway. So I'm giving a little bit because the camera is rolling and we are doing the first podcast for the Retirement Income Source radio show / podcast. We are on the radio every Sunday from 11 a.m. until 12 noon Central Standard Time on iHeartRadio, on WJBO here in Baton Rouge, Louisiana. And today, this Retirement Income Source, as hosted by myself, Drew Pelton, I am talking about effective investment approaches. And effective investment approaches normally center around and are under the category of income investing. And a lot of times I get from people, wow, income investing. Well, Drew, I don't need any income. I have plenty of pension money. I've got plenty of Social Security money in my household, and we really don't need any money. Well, first of all, let me say this. You might not need any money because of pension and Social Security money, but one thing is, if you, the investor, have any required minimum distribution money, then, meaning, I should say, if you have any qualified money, you're going to have to take required minimum distributions. And where I was going with if you have any required minimum distribution money, you're going to have to pay taxes on it. You're going to have to take money out of your qualified plans, 401k, 403b, 457b. These are retirement types of plans. And those numbers, by the way, are numbers that reflect and are the Internal Revenue Code numbers for the section of the IRS Internal Revenue Code tax law that allow for these retirement plans that give tax deferred growth, and particularly for anything that's not a Roth, you get pre-tax savings. So all of that is built into the code, into the plan structure as designed by the IRS. Well, the bottom line is, for anybody at certain ages, you have to take money out. Now, those of you that are a little older, you may have already started taking monies out at age 70 and a half. The rules changed with the Secure Act that was passed a couple of years ago, and there's Secure Act 1 and there's Secure Act 2, and the age changed from age 70 and a half to age 72, and then it's now gone up to age 73. And for those that are more than 10 years, and it depends on your date of birth, your year of birth, some of you who are younger, I'll just say, if you're in your early 60s, you're going to be able to take your monies out at age 75, meaning you can wait until then if you want to. In other words, you do not have to take the required by who? The government, required by the IRS. You are required to take out a certain percentage of your monies out of these qualified plans. It's important for you to know that. All of this said is that when you're investing for income, when you're investing for income, where you are taking income from income, what is income? I have to say, digress for a second to come back to answering that question. So many people, I find, are unclear about the fundamental components of any given asset, any investable asset, that it normally has two components. It has an appreciation growth that could come with a loss component, effectively the fair market value, the value of the asset. That's what we might call the G part, the growth part, which, in parentheses, I'll say has an L part. So that's the value of the asset. Most of you, when you're working, that's what you think about it. How much money did I make? Well, I had 100,000 and went up to 110,000. I made 10%. I made $10,000. I have $1 million. It's up to 1.1 million. I made 100,000. That's 10%. Same kind of an example. Any number you want to use. That's the growth of the asset. But most assets have some part of their earnings coming from a dividend. Now, assets like the Magnificent Seven and stocks that most of you are aware of just by watching the news, whether it's Apple or Tesla as an example, Meta Platforms as an example, then you are not getting high dividends. You're not getting high yields. So income comes from the asset as an earnings that the asset, this is a second component of a return. The total return is TR, total return equals I plus G. You want to understand this formula. Now, I know a lot of people, I find there's a lot of people copying, oh yeah, you need income, and they try to talk the talk, and they're not really diving deep or explaining how this really works, because why would you want to talk about income from an asset when the income isn't very high? I mean, if you're all in a growth only type of a stage because you're in the accumulation phase of your life, or if you just keep moving in that methodology in retirement, which isn't normally the best thing to do, because what if you have losses? You could find yourself in trouble. So you want to understand TR equals I plus G, total return equals income plus growth. There's a little saying I like, which is, if you want to have a retirement that's stress-free, invest more for the I and less for the G. When you are in retirement, you want to make this shift to a way, to an approach, to an effective investment approach, which is what I'm calling the name of the show today, effective investment approaches. And effective investment approaches have to do with this whole focus on income, but the income's got to be high. So certainly you could invest in stocks like the Magnificent Seven or any other kind of high appreciating asset or stock or even mutual fund. But when you do that, you have to understand that if markets are down, then in that situation where these assets that don't have high income and the markets are down and the asset is down in value, more than likely, depending on how much money you're taking out, you will be invading principal. You'll be selling shares. And this is not a good thing in retirement to sell shares, because when you sell shares, when you're not earning money and you're not adding money, you're never going to get those shares back, because you're not going to get the shares back because you're not adding money. And when you have less shares and the stock market goes back up, well, with less shares and the stock market going back up, you're going to have less money. This is pretty simple to understand, I would think. And this is key. This is fundamental. If you have any questions about this, I would highly recommend you give us a call. And I'll give you our office line, 225-831-1394, right here in Baton Rouge, Louisiana. We are a fiduciary specialist firm where we help people invest for preservation, invest for growth, and invest for income. And when you invest for income and your approach is investing for income, generally speaking, you are going to drive preservation, you're going to drive growth in a more deliberate way without having to take high risk, and you're going to be able to generate the income you need, because it's all about income. Income, income, income. What do you need in retirement? You need income. And again, for those of you that may have high enough pensions, high enough Social Security combination, you may not need income, but you're going to have to take income out of your qualified accounts, your non-Roth IRA accounts. So today we're talking about effective investment approaches. And as I was talking about earlier in the first segment, I was talking about two big mistakes I see that people make. And one is buying product where they're not doing process, they're not doing planning, they're not putting together a strategy, an effective strategy for income. And they just buy a product that looks like it's good, maybe the product like an annuity. And a lot of people like buying annuities, and they want to be done with it too fast. And they've got somebody, the local product salesman, selling them an annuity, and maybe it has some income and they don't realize all the dynamics, and it might not have the growth factor it needs. We were talking with somebody this week, a good client of ours, and they had an old annuity that they still were holding on to that they asked me about. And I will tell you, the term expired, And so they felt free to reallocate and reinvest the monies. But the fact is that there was only a 2% return on average over the 10 years. Let me say, oh my goodness, that's not a good thing. It's nice that they didn't lose any money, but to keep up with inflation and to have good returns, at minimum, I would think you would want to make 5 to 6, 7% on any asset. That would be an easy objective to have. So a very ineffective kind of an annuity that just didn't work. It had a lot of smoke and mirrors to it in the sense of it had this faux money, and it was sold to the person with this faux money. The client of ours, never really understood what they had. And so many of you have annuities that need to be fixed. If you'd like to call us about that, we'd be happy to help you. You can call us on 225-831-1394. I'm happy to do a complimentary analysis of any investment that you're utilizing to see if how well it's meeting up to the standard of high income for you. I'm giving away today a book called The Common Sense Income Strategies. Common Sense Income Strategies by Michael Eastham. It's a great book to help you understand the power of investing for income. If you'd like to get a copy of that book, you can call us on 225-831-1394. Or again, if you'd like to talk to me off air, please give us a call on that same number. Now, for those of you that might be listening in evenings, anytime, and now with the podcast, many of you are going to be able to watch this podcast, obviously watch and listen to the podcast anytime you want. And if you're calling on the weekends or anytime in the evenings, you can call us on 1-833-974-1833. That's 1-833-974-1833. And that's our toll-free number. And you can ask for the book, or you can ask to talk to us about coming in off air. So be careful for many of you who have bought a product, and if you need a complimentary review, we're happy to do that for you. Or if you're thinking about buying a product, don't buy a product. Enter a fiduciary process where you're doing planning and you create a strategy that's best for you in your retirement. The other thing that I'm going to re-talk about when I come back is those of you that are more savvy than others that may have been doing your own investments where you think you're doing better than others, but the fact is there's a lot of room for improvement, as well as what do you do from a legacy perspective, and what do you do when something may happen to your health and you need your spouse to be tied in and linked in to the right firm to do what you want to do philosophically with your investments. Well, I've been talking about that, and that has to do with starting the relationship sooner than later. And I'll talk more about that when I come back after the break. All right, thanks for being with me. You're listening to the Retirement Income Source radio show and podcast. Thanks for being with me today. I hope this is making sense. Give us a call on 225-831-1394 if you have any questions, if you'd like to get a copy of the book. All right, you don't want to miss what I'm going to cover when I talk to you about the do-it-yourselfers. And even if you're not a do-it-yourselfer, if you just want to get it right, what do you need to do? I'll be talking about that in the third segment of the show. All right, don't go anywhere. I'll be right back. Welcome back, or thanks for joining me. If you're just tuning in, you're listening to the Retirement Income Source radio show and podcast. Our radio show has been on WJBO and iHeartRadio for a number of years, to say the least. And we are now just today. This is our first podcast. I'm excited, and I hope you are. If you are tuned in, if you are watching and listening, thank you for joining me. And I hope you'll be back for other sessions, because I believe that what I share will help you make good, wise, smart, intelligent, effective decisions in your retirement investing. Today, I am talking about smart approaches. I'm talking about effective, as in good, smart, effective investment approaches. Part of that has included talking about what does not work. I've been talking about the power of income. That's what we talk about on this show, because it is about investing for income that gets the job done, particularly in retirement. One of the biggest problems I see that investors have when they enter retirement, and even right before they do, but certainly once there has been a shift, a change to a retirement status, is too many people continue to invest their monies in an old strategy. And the old strategy is the accumulation strategy. Why is it old? It's old because you're no longer accumulating money. When you're in retirement and you're in the distribution phase of your life, and you're in the phase of not adding money, you want to invest in a strategy that meets that situation. And that situation is most people need income when they are in retirement. And don't you want to get income from income? Income from yields, income from dividends and interest. That's the power. That's the power of effectively and intelligently, wisely investing in retirement. Income, 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 we say. It's all about income. And when you are investing for income, you also are driving preservation and you're driving growth. You are able to keep up with inflation when you start looking at the overall approach where income is a significant part of the total return. Most people have learned to think about appreciation. They've learned to think about, I have time. And when you're in the accumulation phase of your life and you've got decades of investing to do, and you are adding money to your investments, and you're doing dollar cost averaging, and you're buying shares when markets are down, meaning you're buying more shares when markets are down, and you've got a match. Many of you had a match from an employer, and you put all that together. The time, the dollar cost averaging, the match going in, and you're getting pre-tax savings, which is helping to reduce your taxable income. These are all strong and powerful things in the accumulation phase of your investment life. But when you are in retirement, you need to make the shift to a distribution phase strategy of investing when you are going to take money from your investments. And even when those, as I've been saying earlier in the show, if you don't need to take investments, you don't need to take income from your investments, well, what might you have to do? Most of you have to do. Most of you have qualified money, qualified retirement money. That means pre-tax savings for the most part. Roth money is qualified money, but you don't have to take any money out. But your pre-tax savings, your qualified money, your non-qualified Roth money, all of those types of monies, IRA accounts, 401ks, 403bs, 457bs, TSP, thrift savings plans from the government, drop plans when you work for the state, particularly here in Louisiana. The state of Louisiana has a drop plan for many of their state workers. These kinds of plans force one to take money. The governments force you to take money out at either age 70 and a half if you've already been taking the money out. That was the old age, and now it's gone from 72 to 73, and if you're young enough, it might be 75. But the bottom line is that you are going to have to take money out of your investments. What does take money out of your investments mean? Well, do you want to take it out of principal or do you want to take it out of income? It makes sense to take it out of income, out of the earnings of the asset. No matter whether it's up or down, if you can take it from yields, from income, then you won't sell shares, you won't invade principal. This is the power. We've been talking about two fundamental mistakes that many people make, which is one is they buy product and they don't do planning to get a strategic approach and get professional money management working for them, investing for income. And the other is where do-it-yourselfers think that they can outbeat a fiduciary professional income specialist type of firm like ours. And our fiduciary firm, and we trade ourselves, meaning our fiduciary firm, trades on the Charles Schwab platform or the Fidelity platform, depending on what's good and right for the investor. As an institutional investor, we're able to invest monies as well as the retail side, to say the least, or as well as the retirement side. All of these firms like a Charles Schwab and Fidelity, which are two of the biggest broker-dealers in the world, have three primary divisions. They have their retirement plan division, where there's the retirement plans for corporations or organizations. That's one. Two is the retail side, where an investor could go themselves directly to the company. But on the institutional side, you work with a fiduciary, a registered investment advisor, as our firm is, where we have 100 offices around the country. And when we are investing monies for our investors, we are doing it in a tailored, customized way, using individual securities to get the job done to invest for high income. It's inclusive. The institutional side effectively is inclusive of all that's on the retirement side, meaning the retirement plan side, and the retail side. And you want to know that because you can get the best of all worlds when you work with a true income specialist fiduciary when you are working on the institutional side. You don't give anything up. And this is all back to and relates to the do-it-yourselfer thinking they're going to do better. Our fees are very, very low. I don't want to quote a fee. I mean, I will tell you many of our investors pay less than 1% to get professional money management because of the volume they have. Generally, it's probably thought 1%. We have, generally speaking, low fees. Smart Asset, a company that does a lot of articles online, did a study, and their findings was that the average investor averages 2.2%, meaning they average 2.2% in fees that they are paying throughout their lifetime. Now, how does that happen? Well, one is that there are a lot of hidden costs many are not aware of. Many people may or may not realize that mutual funds have embedded fees within those funds. So you may not see it, you may not pay it directly, but it's coming out of the investment. And then, of course, there are many people that have a combination of mutual funds and an advisory fee. And it's easy when all is considered to understand that somebody might be paying, and the averages are, according to Smart Asset, 2.2%. That's significant. That's huge. And I'm telling you, as a professional money manager, that it's not necessary when you are working with a true professional money manager using individual securities, when our fees are in the range of 1%. Sometimes they may be a little over 1%. Many people we have are under 1%, but an easy number is 1%. Well, if you're paying 1%, but you're getting yields of 5 and 6 and 7%, well, if you net out 5% compared to most do-it-yourselfers, I find, are at best, if they're lucky, 3.5% to 4%. on their own, even if they're not paying a fee. You want to know what the net is, and then you want to have a team. What happens if you're not able to invest the monies because you're ill or there's a sudden passing away, as an example? Is your family prepared? That was the other key thing I was talking about with respect to do-it-yourselfers, wanting to be prepared for their spouses, particularly when their spouses are not involved. One other effective way of investing is simply to make good and smart decisions. One of the things that I see get in the way of people who are investing and sometimes not investing, where they just get frozen, is that's it. They're frozen. They're frozen because of fear. And fear turns into procrastination, and procrastination goes on to the point of no decision making. When you are investing your retirement money, you absolutely want to think even more than going to a doctor. Most people, I think, go to a doctor once a year for a checkup. Maybe you go twice a year. Some maybe just go every 2 years. Well, maybe that's okay with a doctor. Money management doesn't have to be difficult, but I know this past week we had a couple of people, had a gentleman in, a newer client, and he came in for a 6-month review. Now, he's been in for a quarterly review. So whether it's quarterly reviews or every 6 months or whenever you need, because it's key to make sure that your money is on track. I want to say, with respect to do-it-yourselfers, to go back to that, I know many of you have maybe not much to do, and maybe you're bored with the TV, and maybe you don't travel all that much, and maybe you don't have a hobby, and perhaps investing is your hobby, and maybe that's okay, and maybe that's good, and maybe you should manage some of your money. But when it gets down to performance, results, best balance, you want to have a team of professional money managers that customizes, tailors your investments for you to get the job done. And then be prepared for worst case scenario. If your wife or your spouse, and maybe you're a spouse that's investing and the husband's not investing, but whatever it is, a lot of times it's the man and who's doing the investing. Well, are you prepared? Is your wife going to be okay if something happens to you? Well, don't just give her a business card. Let's say you're watching this show and you say, perhaps, hey, I like that guy, Drew Pelton. He's talking about investing for income. I think that makes sense. I'm going to write down in our book of when things happen, the emergency book, we'll call Drew if anything goes wrong. Well, it'd be a lot easier if we met. It'd be a lot easier if the spouse met us in our firm. It'd be a lot easier if we did at least a little investing. I encourage that. Now, I want to go back to this third, first of all, ineffective thing that I find people doing. Remember, number one, people buying products. That's not good. You want to have a process and planning. 2, do-it-yourselfers that are not fully, completely organized, as I've just suggested, where you at least allow a firm that you believe in to carry the ball in case something happens. And the third thing is just the simple fact that many people are afraid of math. They are not good with math. They don't like math. They're afraid of math. They don't like numbers. They don't like money. They don't like finances. They know it's important. They need it. And then what do? People like that, maybe that's yourself listening in, and you run for the hills. You put the cover over your head. You put your head in the sand. You hope and pray, but you really don't know. It's not that difficult. You need skill. You need a fiduciary skill provided to help you do the best with your money, because retirement may be 1/3 of your life. That's what the studies say, that you will spend 1/3 of your life in retirement. And I want to say, be careful not to chase big returns and chase markets that might end up causing you problems when the markets turn around. But this third set of people generally, I am addressing, which I think is a very large, broad number of people, which is people that are afraid. And sometimes when people are afraid and they say, well, I don't want to lose any money, and then they go buy a product without doing the process and the planning and having a true strategy. Certainly people that are afraid, I would say, normally are not your do-it-yourselfers. So we might say that those of you that are procrastinating, that have fear, might be the opposite of the do-it-yourselfer that might be overly confident. You need to do what's good and right for you and your family, because money is important. And I think you would agree, and I can tell you from my experience, I see people live better lives when they feel good and confident about their money. If you have peace of mind about your money because it's solidly invested in a way that meets your goals and objectives, where you are investing for income and you have adequate income, you're going to think good, you're going to feel good, and you're going to act in confidence, and you're going to enjoy your retirement a lot more. It's important. So today I'm giving away the book, Common Sense Income Strategies. I would highly suggest you get a copy of that book. You can call us on our office line, 225-831-1394, and I'm happy to get a copy of that book to you. It's a great book by Michael Eastham. He's a friend, a colleague. He's one of our shareholders of our group, Sound Income Group, and I believe that you will enjoy learning the power of investing for income and what you need to know to help you go the distance in retirement. All right. I'm going to take a quick break before I wrap up this show. Thanks for being with me. You're listening to The Retirement Income Source. I'm your host, Drew Pelton. You don't want to miss this wrap up. I'll be right back. Okay, we only have a few minutes left on today's show. Thanks for being with me, or maybe you're just joining in. You are listening to the Retirement Income Source radio show and podcast. I'm your host, Drew Pelton. On the radio, I'm with you on WJBO and iHeartRadio every Sunday from 11 a.m. until noon Central Standard Time. I suggest you don't miss a show. I'm pouring out my heart to motivate you, help you, to get you to think in a way that's going to help you. I'm trying to give you good and great information to help you discern. And I want to say, if you're listening to this podcast, thank you. It's our first one. So we have integrated our radio show into our podcast. And please join me, however is good for you, whether it's on the radio at the time frame I just mentioned, 11 a.m. to 12 noon Central Standard Time every Sunday, or anytime you need or want or would like on YouTube. Please catch our podcast, and we will be doing certain segmentations. So look for me more as we continue to bring forth our radio show through a podcast medium. Thanks for being with me. Join me every Sunday so you can get good and great information, so you can have peace of mind, confidence, and comfort in your retirement. And you can do that through and by the power of investing for income. Learn about that each and every week. Thanks for being with me. Be blessed. Have a great day. We love you. Talk to you. See you soon.